Great to be here in the 10th edition of the LP Summit. So the next session, or the first session of the day, is about patience. Patience and long-term investing in venture capital asset class. And to kickstart this, I'm going to invite Tom Henriksson, General Partner of OpenOcean. Tom, please come to the stage.
Good. Well, actually, we could invite Lisa and Joe to the stage as well as soon as they are ready, because I was kind of expecting to get boos because I'm a GP. Apologies for that. It might have something to do, though, with the fact that I have a special place in my heart and in OpenOcean's heart for Lisa and Joe. I will let them introduce themselves properly. But Lisa Edgar is a strategic advisor to OpenOcean, helping us think about and develop OpenOcean into an even greater VC firm in the long term. So with that, Lisa, please, why don't you join the stage? And Joe Schorge again is a partner at Isomer Capital, and they are OpenOcean's first international fund-of-fund investor. So thanks for that, Joe, and welcome. And indeed, we'll get to the proper introductions in a second, but we're going to be talking about patience. And of course, when you think about something like that, you first look it up on the internet. And it says that patience is the capacity to accept or tolerate delay, problems, or suffering without becoming annoyed or anxious. None of that, of course, happens in the startup and venture world. So if you can stay for the 10 or whatever years it takes to take a startup from zero to maybe $1 billion or a fund to profitability. It took almost 11 years to get OpenOcean's first fund very profitable. Without getting annoyed or anxious, then I guess you have patience. We're going to talk more about that in a second, but now I would like to let Lisa introduce herself because she has quite the background.
Good morning, everyone. It's so good to see you here today, and thank you, Jan, for inviting me to participate in Arctic 15. This is a couple years in the making with COVID and all kinds of travel restrictions, so it's good to be here. I'm Lisa Edgar. I have been known to not have patience, so it's interesting that this is the business, this long-term investing business that I've been in for really over 3 decades. Mostly in America, in San Francisco, working at Top Tier Capital Partners, which is a venture capital fund of funds making primary investments, secondaries, and co-investments. I mostly led the fund investment activity, which was to invest in all those big brand names that people wanted to get into and access. But what was near and dear to my heart was really finding the next generation, the emerging managers, we call them alpha managers in the portfolio, and really helping to get them started, think about how to build their business and how to invest for the long term. Right now, I'm partner emeritus at Top Tier, which means really I don't have any day-to-day activities there, but lots of economics tied up there for all the funds that I was a general partner in. And as Tom said, I am a strategic advisor to OpenOcean, and I do work with some other GPs, LPs, to really help them think about how to create the right portfolios, how to build a firm and a team, and really share all the different experiences that I've had over the years to help make people stronger, better, and to really help change their trajectory.
And is it working with OpenOcean?
It is working. I really enjoy working with them.
We love having Lisa. It's a bit early to tell. We worked together for half a year, so it would be a miracle worker indeed if you would have changed our trajectory already, but it's hopefully happening. Joe, over to you.
Hi, everybody. Very nice to be here. I haven't been in since pre-COVID as well. And I have to say, thanks to Jon. Arctic 15 is kind of a little close to my heart because it was starting around the same time I was starting my firm. So it was small and in the basement and in the beginning. And I don't know, I don't feel completely comfortable in this beautiful room. Look at that. Marble on the walls. And it's just, you know, I'm used to the basements all around Europe. Well, my career is kind of what we do at Isomer mirrors my career a little bit. I was a tech guy, and then I got into primary investing, and then I got into secondary investing. So what do we do at Isomer? All focused on early stage tech, all Europe, primary, secondary, and co-investing. And so our main fund is a hybrid fund of funds, kind of as you described, Lisa. But why do we do that? I never really had a dream to run a fund of funds. It's a complicated business with a thin fee and all kinds of difficult things to manage. However, what is exciting about Europe, but also scary about Europe, is that there is no Silicon Valley. I don't think there will be. Great startups come from everywhere. So we have 100 cities now with unicorns. So what do you do about that if you really want to cover Europe? You need to somehow have eyes and ears everywhere. So what we do is we go find the really smart people in the market. We invest with them as an LP, and then we do more with them, co-investing in companies as they grow, and then buying pieces of companies or funds when other investors want to leave. Everything we do is, the idea is, right now, in some garage, somewhere I've never even heard of, there's a really cool thing starting. So how do I, I'm excited about that, but I'm also scared about that. Like, how do I find it, And so back to the topic at hand, we go super early, pre-seed and seed starting point, which means we have to have a lot of patience.
Great. So I guess with those backgrounds, we'll have some exciting discussion. Let's start on the very meta level. If you're an asset allocator, how do you think about different, maybe mainly alternatives, assets, but you can speak to others as well, and venture as a part of that, and obviously now with the perspective of the word patience. Joe, do you want to start?
Shall I feel that? Well, my biggest window on that is I worked at Cambridge Associates, which is an investment consulting business out of the US. And we would be hired by large investors to run their whole portfolio, but the private part was my expertise. And so you really have to decide, I can invest in buyout funds or real estate funds or infrastructure funds, and they all have a different risk return profile. And us in venture, we live in our little world and we love it, and I'm a fanatic about it, which is why I do it. However, what we forget a lot is you are competing for capital in a way with other things the investor can do. And this is where the patience thing comes in, because I have some really great investors and they're going, you're developing terrific returns, but they sent me some cash back. And there's a real tension there with most investors about growth for the longer term versus short-term developing of cash that comes back that I can then choose what I want to do with. So it leads me to think, and I just been in the US last week with lots of big investors who are making this trade-off now because their venture books just went down a lot. And so I'm very conscious as venture investors, we have to provide a return which is the growth engine, which they want, but also probably in Europe, we need to think more about doing exits, maybe doing earlier exits, partial exits or whatever, to be returning capital. And, one of my favorite saying, it's not a return until you can buy beer with it. You can't eat IRR. IRR is great, but it isn't the answer. The answer is buy an asset, grow an asset, sell an asset, then you have a return. So what I heard a lot last week, and kind of fresh off of this big conference, fixed income's doing really well. People are making 5% on cash. Cash, that's just to let your cash sit there and do nothing, you get 5%. So they're sort of going, I have total liquidity versus you guys who want to hold my money for a decade, for 20%. So that's good if you can do it. But I think that's a real tension, especially right now as markets went down.
I think that's such a great point, Joe, because the interest rates in Europe are not what they are in the US. And a lot of my friends have been buying treasuries, and it really is 5%. And believe me, I've taken money and put it there too. So I get it. And we haven't seen that in so long. I'm just going to take it a little step up. I love working with people that are just starting to build a venture portfolio, because it really is important for people to think about what do they own, what are they comfortable owning. A lot of times it's real estate, not necessarily private tech assets. And then talk to them about, you know, the broader allocation and portfolio construction, because as we know, allocation really drives a lot of returns. It is being a good, what I call stock picker as well, but it's how much are you going to invest in real estate, fixed income, growth assets, you know, buyouts, et cetera. That's really going to make a difference. And to really think about the cash modeling of that. What are the capital calls? When should you really expect any liquidity at all without people doing secondaries and, you know, selling, you know, before things reach full liquidity? I'm a big proponent of selling before, you know, taking some money off the table and getting liquidity back to your LPs, and we can dig more into that, you know, especially as it relates to patience on getting returns. But, you know, you really have to start from the beginning about thinking how your whole portfolio is going to work and what you're comfortable in, what you want, what you don't want. Have a plan and stick to it. I personally, because I do my own investing now, I have a plan. You know, I had a 2.5-year plan, and now I've created a new 2.5-year plan. And that's the way I think. I mean, that's the way we think about it in our fund of funds. You have kind of a fund cycle. I'm going to commit this much capital to this type of funds. And I try to stick to that, and I think that's really important.
So I want to take it to a couple of, let's say, hard facts, if there are such. When we're fundraising, we of course always say that in venture you can get higher multiples on invested capital than in most other alternatives classes, right? But there's also the risk adjustment and of course the time frame. So what actual returns does venture, early stage venture, need to attain to be competitive compared to those other asset classes when you think about the risk connected to it?
Ready? 1, 2, 3. 3x.
Okay.
Hey, come on now.
And that's 3x net?
Minimum net. Always net.
Over how long?
Quick as you can.
Because Joe doesn't have any patience.
I think over how long isn't a real question, because it will take the time it takes. You know, you can't tell when a startup is ready for exit. So I think picking the time, but you'd like to have more than 20% IRR, which gives you some timing.
Okay, those are some hard numbers. Some little birds sing that the best VC firms out there in the wild, wild west of California take some 14, 15 years to mature and return everything to optimize actually the outcome. Is that true?
Yeah, absolutely. And there's one point generally in a life cycle where, and you probably know about this a little bit more because this is really kind of Cambridge numbers, where you settle into your quartile ranking. And that comes what, year 7, 8?
Usually about 7,
yeah,
7, 8.
Yeah, so early on it's hard to tell, and then but once you're in about year 7 of a fund, your quartile ranking doesn't move very much, so you can see how you're performing against others at your vintage year. Now, every once in a while you have some crazy company like there's a company, Tableau. Many of you might use that software. I mean, literally, it was in our portfolio. We owned it a couple different ways. It was not something that people were talking about. It was not a fund driver, none of that. And then all of a sudden, and I don't know how long it was, I mean, it was many years later, that was kind of returning a whole NEA fund or something. It was crazy what happened to that company. That type of thing doesn't happen very often. Generally, the fund drivers get to be clear, and then you see them, but by year 7, you have an idea of what it is.
But I would make 2 comments on your timing thing. First of all, buyout takes that long as well. So this is not only a venture thing. And what you're talking about is the long tail. So, you have, as we all know, cash goes out over a long period. It also comes back over a long period. So you're not waiting 12, 14, whatever years. You're getting your cash along the way. And then there's always this long tail of some asset that, didn't pop or you think it still has growth. I'm a big fan of cutting that off and selling it to the secondary market. I think there's now a very large liquid secondary market where you can say, hey, this is what we do with our LPs. Hey, we've kind of squeezed all the juice out of the lemon. So if you can sell this and sacrifice a little bit of multiple, but have your cash back and go to the next thing, that's a good thing to do. But it's funny, it's kind of one of the most open secrets we never talk about in private markets. In US, I think the statistic is true, I've heard it a lot. Average length of a private equity partnership is longer than the average length of a marriage. You can have different feelings about that, but if you look at the divorce rate and you look at the fund statistics, it's not hard to see it.
But private equity, or were you referring more to the buyout side of it, or any private equity?
All private markets.
Right, because I was going to say that buyout at least returns cash faster, but then it's not relevant to the marriage example.
Yes.
But we should talk about the secondary market because it is a very, very important tool. It's a very active market. There's buyers and sellers. But guess what? You will be selling at a discount. I mean, every once in a while, there's some premium in the big bull markets, crazy things, and there are certain very active, very well-known secondary firms that are very aggressive, and they kind of buy at 50% off. So you're getting your cash back, you're able to redeploy it, but be prepared to take a discount. And the market gets stuck so many times where buyers and sellers just can't come to a point in a place. And it's often because of the lag of the valuations that occur in our industry, right? You're getting, we're just now getting March numbers in June, right? And so there's that lag, but you can see what the public markets did, you can see what's going on, and therefore there's a bit of a difficulty. But the secondary players need to get an uptick because that's how they, run their performance and run their investment activity. And the sellers have to be willing to sell at a discount to what the current NAV is.
So you're both fans of selling fairly early, if you can be very profitable that way, and the secondary opportunities in general. To me, that's a bit against then maximizing venture returns. I mean, it still takes 7 to 8 years to build a unicorn from the very early stages, on average. Yes, some do it in 2-3 years, and that's just crazy. And I hope I'll meet one of those one day in our portfolio as well. But it does take quite a long time. So any reflections on that? I mean, as a fund is 10 years, and we spoke that it might go much, much longer. Shouldn't one wait those 7-8 years to get at least to unicorn status before starting selling? How do you think about that?
Generally, yes. I mean, we're not talking about selling in year 2 or 3. We're talking about you've done your 10 years, 2 one-year extensions. There's still assets and NAV left. Sell that, cut it off, move on, redeploy the capital. That's what we're talking about. And then I get into these discussions all the time with VCs. Now, we're mostly LPs in this room, they're saying somewhat what Tom is saying. Wait a second, I thought you're trying to get your 3x and maximize your multiple because we're multiple investors. Why are you telling me to sell my winners? Why are you telling me to sell early? This is the thing that's going to win. We're not telling you necessarily sell super early and sell it all. We're saying take some chips off the table, get some liquidity back to your LPs, and ride the rest. But to sell some into the secondary market when somebody comes in and then there's $1 billion round or something and you're selling to Insight, I think we like that.
Yeah, I'm really cranky about this right now. So I have to be careful what I say, but This logic, when you argued it 3 or 4 years ago, went on deaf ears. VCs wouldn't listen, right? Oh, it's going to ride forever. VCs are optimists. That's why they do the job they do, and they must be optimists. Good for them. Me too. I'm with you. However, when valuations are stupid, which they were in 21 and the first half of 22, that's exactly the moment to sell. So if SoftBank wants to pay a silly number for a company, great. Take my shares, or 20% of my shares, right? Exactly what you say. And guess what? All the venture portfolios that did not do that, their NAVs dropping like crazy. So they have no DPI. They could have had some cash in the bank. They don't. And I'm really cranky about one fund in particular, which I will not name. Very high performing fund, some great IPOs, some great stuff. Half the fund has been destroyed over the last 18 months.
I know who you're talking about. Your colleagues in the London office, when I was there last week, were talking about, I know exactly who you're talking about.
Okay, all right.
Come on, names,
It's
names,
not like,
names.
because LPs talk, GPs talk, like now we know this particular fund has really messed up. And these were public companies.
I don't know.
And I understand lockups, I get all that, but
This wasn't a lockup issue, most of it. And I don't know if we're talking about the same fund or not, but just by way of example, LP experience, I was the broken record, turning up and saying, hey, if those big investors want to sell a bit, sell 20%. You're up 50x on this. This is not sell in year 2, 3, right? You have 50 times your money in this company, or 35 in one case, or whatever. Please sell something to take that risk off the table. And a crazy, there's this balance between greed and the search for returns, right? And I think at some point, if the company's returning the whole fund, or you have a 30x, or you develop your own metric for when it's time. And I became the broken record, and I gave up because I was, turning up to every meeting saying the same thing. It's like, okay, so I don't go to the meeting anymore because I'm so annoyed about it. Well, sure enough, here we are. The market's tanked. We lost a lot of value. They lost a lot of value. And the LPs lost a lot. The partners of the firm lost millions in personal carry they could have acquired. So it's, unfortunately, it's a train wreck of an example that recommends this strategy.
At this time, I will have to comment. I mean, as a GP, because we were in the same situation in our first fund in 2021, we knew Truecaller was going to go public. And we did decide to sell down in the private markets at lower valuations than what it was expected to go public at, and at lower valuations than what it went public at, to get to a lower ownership percentage so that we only had a 3-month lockup instead of a 6-month lockup, which saved our asses. So then we actually were able to get out in January 22 when it was still worth 3 billion. Now it's worth $1 billion plus or so, although the company is actually wonderful. Increasing returns, growing great, profitability strong, and so on. We totally believe in the company. It was driven by the fact that the fund was 10.5 years old by IPO. And yes, we might have had an inkle that markets are on the top, but it was a really hard decision. It felt super stupid when the company's valuation goes up to sell at a discount twice before the IPO. And so it was a tough decision.
And how does it feel now?
Well, now it feels great.
Okay.
Yeah. So we were fortunate to get it right, but it was not easy at all, and we had big debates in the partnership and so on.
But this is why we pay these high VC fees, for you to take these hard decisions and to think it forward.
I think there was a question, by the way. Imran.
So I think this is more a problem in Europe than the US, because you have firms that have been around a long time. Most of European ventures less than 10 years old at the VC firm level. And so I think if you're less than about 34 years old, you've never been through a cycle. And therefore, my advice to all these groups is to try to get an old guy around the table one way or another. And by guy, I mean man or woman, Because and I don't say it because I'm an old guy now. I say it because if you've lived through these cycles, it makes you think differently. It leads you to the secondary thinking, right? That we know markets don't always go up, markets move. But if you've never experienced it, you don't build it into your deal structures or your thinking on the selling and so on. So my best advice to these young firms, they're out doing the great work of finding startups and growing them, but I think they need some advisors around the table in one form or another who've been through those cycles. So we always look for that with groups we invest with. How are you getting that, longer term pattern recognition into your firm? Doesn't have to be a lead partner necessarily. Could be LPAC members, could be advisors, but are you using that logic to manage your funds with or not?
But there were a lot of emerging managers and new managers started, and some that had never invested other people's money before, which is generally not something that we would like to back very often, or if at all. And it looked so easy, is what I used to say. This looks easy, but it's really not. Somebody corrected me once when I said it looks easy, and they're like, no, it is easy. Because it was easy for them. It was easy for them to raise capital. It was easy for them to invest the money. It was easy. I don't think they're saying that right now.
So Europe has, I will take that in a while, but there was some Europe connection here and Europe has, of course, come of age, developed immensely in the last 10 years. So maybe the answer is now a little bit different. I think earlier, you really needed patience in Europe, but is there a difference still in the patience needed as an LP, for instance, in the European ecosystem versus if you're focusing on the US? Clearly a difficult question.
I'm not sure there's much of a difference. I mean, it's more about big name brands with very solid LP base versus those that aren't. So it's must-haves versus nice-to-haves. Most of those must-haves are in America, not necessarily in Europe. There's 3 maybe in Europe. So it's more about that in this market. It is a less established market, but it feels, I came over to London in 2019 with Top Tier, and I just loved seeing what was happening, but because the world's so global, I mean, it's a different market, it's a less mature market, but, like you, Tom, you're going to the Valley and, New York and different places all the time. I mean, you can get the learnings and try to understand what's going on in the different markets. So to me, it doesn't feel quite as different. It's just not as mature, and there are not as many must-have managers.
I would agree with that, and the underlying fundamental is that building, the tech we're building and the business models we're building are quite the same. So in that level, there's nothing different. What is different about Europe is we have 44 countries that make up Europe, not one big one, and so the way you scale a company is a little different. How you raise capital is a little different, and where you sell it might be a little different. But I have a different view on the emerging managers. So when I look across Europe, who's backing the big things early, it's mostly emerging managers. The Excels and the indexes come later, 2-3 rounds later. So I always say, we have LPs that are Sequoia LPs, and they had a great exit with UiPath. This wonderful company from Romania, IPOs in New York for $35 billion. Yay, Sequoia! There are 3 seed funds who had a much bigger return from that. I mean, life-changing return from that, right? And that's where I want to be as an LP. So that takes me to back a lot of people who have not managed other people's money before. It's an edgy thing to do, and my view on it is not have you managed other people's money necessarily, rather are you, what VCs always talk about, the coachable team. So is this a team that can take input, because we know the future looks different, so you need around you experience and so on. And if you're kind of blinded by your own thesis and aren't able to adapt, I'm nervous about that. I'm more nervous about that than I am your past experience. You need a tech experience and investment experience. But in our portfolio, which is mostly emerging managers, it's not the ones who've never managed money that are doing badly now. It's the ones who aren't taking enough outside input, in my opinion. I mean, I'll give one example. The thinnest track record I ever backed, and I hope the thinnest track record I ever will, but absolutely brilliant technologists. And they really wanted to learn how to build and manage a fund. And so we said, well, we know about those things. We'll help you with that. You do the tech part. And they have a towering strength in deep tech. And they listen. And so not that we have all the answers, but they listen to all the people around them and adapt and grow. And so I'm pretty comfortable they are the future rock stars of Europe. I'm not worried about them. But their prior record was, even as I'm signing it, I'm thinking, is this the right thing to do? You know, I'm very happy we did, because I think they're doing really well.
And here I thought the greatest predictor of future returns is the top quartile historical returns, but maybe not. Maybe not in our field.
I think in venture, it means it's less than any other market. Because by definition, the future looks different than the past, right? So if you're backing what worked last year, you're probably already finished.
So I'm doing a bad job because I'm not timekeeping. How much time do we have left? All right, perfect. We had a question over there.
Well, the incentive structure is pretty much the same for all funds, so that's not different from one fund to the, carry, right? I think, as I said, VCs are optimists, and so this particular fund did a very good job of finding high growth companies, and they grew very well. And so when you're on top, the human instinct is to say, well, it just continues, right? Oh, look how great it's, we found this thing when it was two guys in a garage, and now it's a multi-billion, and it's going to keep going. And they weren't without some logic on their side when you looked at analyst reports and you looked at what the products could be capable of in their markets. And so that was really I don't think it was only greed, although I do feel there's an element of that. They're probably doing their little carry calculator and going, well, I got a lot of money now, but I could have a lot more money then, And I heard things like, but we'll sell when it reaches this number, which is kind of an arbitrary, I believe it should be worth that. And a lot of my argument with them was, well, the public markets don't care what you believe. You're not a public markets investor. That's not your job. Your job is find an early stage private thing, grow it up, and get out. And if you IPO a company, all of a sudden it trades on the sentiment of the market, what big institutions are doing, completely different factors. Not a lot to do with the fundamentals of the company, which is what we know about and what we in private markets. So, I lost the argument, they held, and they lost the value.
Any thought, Lisa? Or?
No, I was just thinking, like, if it is a public company, you can distribute the shares to the LP and you, the GP, and you can hold it forever if you want to.
I said, give me the shares, for God's
Exactly.
sake. Well, they have now, but that in Europe is not, LPs don't want shares.
In our early fund agreements, we weren't allowed to do it. Nowadays, we can.
Yeah, and I spent a big part of my early career at Horsley Bridge managing 1 million shares of Amazon, 1 million shares of E-Tech, 1 million, as a fund-to-fund investor, getting all those distributions. So I understand that part of the market.
Now comes, really tough questions to the two of you. So the first one is, tell us about a time when you wish you had more patience. Either of you go first.
You said you
Lisa's
were going to ask this, and I don't know. When I wish I had more patience. For me, it's about people. And so I think it was at a time where I was hoping a team and a person would develop faster and differently than they did. Yeah. And I just didn't have the patience for waiting.
Okay. Joe, any?
Well, I'm usually accused of the opposite. I have too much patience. So when I look back,
You're a rare human being.
Yeah.
In our industry, at least.
It works for me sometimes, but I don't know. I think this trading idea, so a lot of this topic is really around trading, and in the US, people use that secondary market as a way of trading, and they look at the opportunity cost of capital to sell out of things and so on, and we don't really do that here. And I think where I sometimes wish I had a bit more patience was the early stage takes time. And so you know that, and don't get in that business unless you don't know it. But I, banging my drum to sell, probably I did a couple too early. But you said it earlier with Truecaller, it's impossible to know, right? You take a decision with the data you have at that moment, not what you will have in your crystal ball.
I will say one thing, experience, time, you get wisdom, you get more patience. I have a lot more patience now at my age than I did when I got in the business when I was 24. That's for sure, because you want things to happen now, right? It's a natural human thing, but I have a lot more patience and I always say I'm more zen about it, but just can kind of step back and look. And sometimes doing nothing is, not forever, but sometimes doing nothing is the best thing.
My colleague Ralph, who's the wisest of the OpenOcean people, he has this saying that if you indeed wait and do nothing, half of the problems will solve themselves. And he's at least half right in this, because it does happen surprisingly often. Having said that, when it comes to, let's say, building and coaching startup teams and investing in startups as a GP, very rarely do we have too much patience when you should, and sorry to say it, change the CEO or change the chief revenue officer. When you get that feeling in your gut that now is time, it's probably half a year earlier when you should have done it already.
Can I give you one example where I misjudged patience in another person to my cost? So we did a direct co-investment into a software company, and there was a serial founder, and the founder, terrific guy, really scrappy, excellent CEO and so on. But he had a habit in his prior two companies of selling early and having, you could argue, a lack of patience, right? Selling the company at 100 million, 150 million when he really had a lot of potential. So he builds another company. It's in our portfolio through a VC, and he needs more capital to grow at some point in time. And so he said, yeah, but this looks great, but are you going to build the billion-dollar company this time? Because he had, even at that moment, early in the company, he'd built the biggest team in the world in that category, and was beating Google, who were also competing in that category. So it had the potential to be a killer, this thing. And he said, oh, yeah, if you give me the money, then I'll have a longer runway and I'll grow, i.e., I'll have the patience, to ride to the billion. Well, we did it, and 2 years later, he sells the company. And he sells it for like $250, which to me is a great failure of his own patience. I guess there was some fear that maybe markets would, this was a few years back. So, we had a 2x or something, which is not why you do venture. But there was evaluating this concept of patience. Did the CEO really have what it took to keep building for some more years to drive the big outcome? And that, he sold it to a strategic who now have built it, and it's a world-class product. But what a pity he didn't, have that patience.
And that dialogue at the beginning of the relationship about what you want to achieve and when you're ready to sell and in what circumstance are you going to do what, we find that dialogue super critical. So that indeed you don't get too many of those surprises. You still get them, but less.
I should have called you in. Now I know. Tom, have a look at this. See what you think.
It's not the intention of my comment. Thank you.
I think the market is what the market is. So if you need capital, you are at the whim of what the market's going to pay and what kind of terms you're going to get. So it's hard to protect yourself in this environment. If you're, I assume you mean you're already in a company and it's growing and now you got to raise more capital. People did a lot of cuts. They tried to get to at least break even, if not profitability. But this is the time of the market. I was thinking something else when you first started asking the question. If you are an investor and have capital, you should be investing now, because it is a better market. You shouldn't stop. You shouldn't be afraid. You should continue to invest now, because there is better valuations, a little bit better terms. You have a little bit more time. You can do more diligence, all of those things. So for Joe and I, when we're looking at doing due diligence on funds, we will be looking to see who continued to invest in this market, or did they, do all their investing in 2021 and then nothing, in this market, which would not be good for performance.
Yeah, everything's on sale now. So if you have capital to deploy, I think this year, next year is the environment that we prefer to the past couple of years. But what I see a lot in the case you describe is people try not to raise money to extend the runway and so on. If they must raise money, then often the new money coming in is demanding quite strong pref stacks on top. And a few of the deals we've seen lately, the existing investors have an opportunity to participate and to convert their shares to the prefs usually, but they're getting washed out if they can't participate. So this is where also the keeping some follow-on, that follow-on ratio becomes really important for VCs, for co-investors and everybody. And people are going to get washed out, because we see, when you see it written up in Sifted or TechEU, it's a flat round, but it's not actually, because there's a whole bunch of terms being written that in a mediocre exit case crush the early investors. And that's something to be, you really need to read the detail and be careful now.
Yeah, and just lastly, what's happened in the past during these markets is sometimes the VCs come by and want additional capital, an annex fund, some type of other fund to help support the companies. Generally, the LPs, which are also stretched, the answer is no. That management fee we pay you, you need to look at your portfolio, decide how you're going to allocate the capital you have left, and manage the portfolio to get the best return. And this is where the experts and the people, sorry, Joe, that have managed other people's money and that have done this before, or that have advisors that can help them think through this. This is where they'll be the winners. But we've seen this show before, but the folks that are 34 and haven't been in the business that long have not.
Time flies when you have fun, so really sorry we can't take any more questions, but have to let the stage for the next ones. Let's give a great hand for our two professionals.